Good afternoon. This is Bakes, Kevin Baker with Bakes Takes. Welcome to the podcast. It is Saturday, April 24th. It's great to be back. Hope you're having a great weekend. Why I do this real quick, especially if you're new to the show. We have a lot of new subscribers, so welcome all of you. Bobby, Jack are my sons. They're in their 20s, and I speak to them, and I invite you to listen in. They were recent graduates of undergraduate programs in business programs. And they and their friends would fire questions at me. What's the 10-year doing? What groups do you like? Why are stocks down this week? And I'd give them my opinions. I've been 25 plus years on the buy side, mutual funds, institutional firms, hedge funds. Kind of know where the bodies are buried. Went through the '87 crash, had the hubris knocked out of me. And I started my journey, and I just read everything I could get my hands on, went back for my MBA, and I was drawn to technical analysis because the technical guys and gals weathered the '87 crash way better than the fundamental people did. I think it's a fact. And so I go technicals first and fundamentals second. Technicals are reading the charts for the uninitiated, and it just works for me. And you decide what works for you, but that's where my bias comes from. You'll find that real quick. I read the Journal, I read the Economist, I listen to podcasts, I devour newsletters, I take all these crazy themes that I come up with and plug them into Google Alerts and see what they kick out. And I point you to them. I always give attribution. If you want to do that reading along with me, great. But I'll do it for you, and I'll tell you that I eat home cooking. All I do is talk about what I invest in, what interests me, and I have no conflicts. But tell me, especially new folks, what are your pain points? What are problems you'd like me to address at least? Topics I should cover. I'm all ears, and thank you very much. My disclaimer, this is not investment advice. Please conduct and share your own due diligence. This is becoming more interactive with every single week. Spent a lot of time with you on social media this past week, and I wanted to continue and grow. So fire away. And you did. And I'll start off with GameStop, GME, and we hit a nerve where our one video's got 17,000 views now, Mike. Again, it was more controversial than I guess I thought it was, because what I'm realizing is that I think everybody sees what I see after doing this for 25 years and going through millions of charts, and not everybody does. It's sort of like Malcolm Gladwell's book, Blink. There's sort of an instinct where you recognize something and you just make an assumption and a decision. So here's GameStop again, and I'm just drawing this with 1 week under our belt, and here's the wedge and the 212 resistance line, and we're sitting at the bottom of the wedge. And if we break below it, then the wedge breaks to the downside. I know some of you give me a hard time because we haven't hit 212 yet. Well, I was very clear. If you break below the wedge, that's completely fine. If you break above it, it's bullish. And if you break above 212, which is kind of a double whammy, if you will, then you're really going north. We'll see what happens. It's Saturday. There are news events on Monday. We'll see if they come up with something about digital transformation that excites people, and we'll see how we go. And then as soon as I bring up GME, everybody asks about AMC Entertainment, the movie company, and the movie theater chain. And they're pretty unrelated, except for that they're Wall Street bet stocks. And they look very similar. There's these wedges that I keep talking about. They're all over the place. And AMC is another one. Here, we're sitting at the top of the wedge. The volume's picking up a little. So frankly, it's looking better than when I called it a dead cat bounce, that we're still below the price where the bounce happened. But my bias here is that the volume picks up a little bit more on the down days versus GameStop, where the volume evaporates on the down days. It's like people don't want to sell, and because there's so many HODLers out there, then AMC looks a little bit worse than GameStop, but it looks pretty positive. So it's just a little bit less positive than GameStop. And oh, by the way, the short interest that everybody points to so much is down to 10 million, down from 70 plus on GameStop. And if this number's right, the short interest on AMC is 73 million, which is more than the shares outstanding. that could be wrong. It could be dated, but there's more kerosene, to use my analogy before, with AMC than GameStop. So do with that what you will. Just for what it's worth, GameStop, I participate in that only through the XRT, the retail ETF, where it's about 4 or 5% of GameStop is 4 to 5% of that on every given day, just for full disclosure. Next, Charlie from Texas wrote in, thanks a lot for another great episode. Love the episodes lately, longer form ones as well as the abbreviated tidbits. And I've got a couple questions and suggestions below, and the help would be appreciated. Asked about gambling stocks. I'm not going to go through the whole questions. Asked about ETFs and PENN and DraftKings, and here we go. So, the ETFs that I found that are gambling related, not gaming and esports, which I participate in through Hero, HERO, the gaming and esports ETF. This is Roundhill Sports Betting, BETZ, clever, huh? And it's one of these recurring themes. It's had a big run coming out of COVID. The volume is picking up on the downside, and it's rolling over a bit. It looks like a Head and Shoulders to me. I didn't draw it here, but it looks like it's rolling over. It isn't cataclysmic. It's had a hell of a run, and it should rest and consolidate. More on that later. And so the other thing that I recommend you do, as soon as you have a new idea, go to the chart, or you have a new suggestion for an idea, go to the chart, and then go to the fact sheet. Just Google, whatever the symbol is, then fact sheet, and it comes up with the top 10 holdings. And here, DraftKings is the number 2 name, PENN is the number 4 name, and it's about 9% of the portfolio. So if you want to participate, this is one vehicle, and I'll go into those individual names too. VanEck Vector Gaming is the next one, Charlie. BJK, Blackjack, again, very clever. And it's very, very similar. You know, it's had a big run. Looks like it's getting tired. Looks like there's some distribution going on. The volume is picking up on the down days. And then I go to the fact sheet. And here, the DraftKings is a bigger piece of the pie, 7%. And Penn National is about 3%. So that gives you about 10% exposure to that particular those stocks within the ETF. So now here's Penn, and this is the most extreme example of those very similar looking charts. I mean, Portnoy sold to Penn, Barstool Sports, and then got crushed, and this stock went down to $375 at the bottom, and we thought the world was coming to an end. And then he became Day Trader Dave, or whatever the hell his name is, and we went from 4 to 142 in less than a year. Pretty good move, to put it mildly. And now we've settled back into 89. Just for what it's worth, to give you sort of a perspective, and all this is consensus analyst estimates. They're not mine. They're going to earn 228 next year, so we're around 30 times. The analysts project that earnings grow 40%. So it is not cheap. It's had a big run, and it looks tired, and it's going to wait around. I think it's going to consolidate here for a while. I'd be surprised if the earnings released, which is coming up in another week or so, I believe, if that makes this blast through to new highs. Could, but it feels tired to me. And so I'm going to take this time to give you my rationale for ETFs versus individual stocks. If you have $500 million and you can diversify, then that's great. But for smaller amounts of money, I like just identifying, in my case, 10 big themes. Buy the ETFs that best exploit that, and then enjoy them, like uranium, which I've been talking about ad nauseum. And it takes away the individual stock risk. I mean, if something particular happens to Penn or DraftKings, you're obviously going to get whacked, and you're also going to enjoy the fruits if it works out great. I just like being more diversified via the ETFs. It's my own personal preference, but I want to talk about what you want me to talk about, and if it's individual stocks, then so be it. The other part of this is it goes back to my history as an analyst and a portfolio manager, where we would have buying individual companies. We would really go into the weeds. I have a multi-page interview sheet that I developed over the year with some very, very bright mentors. All the questions that I would ask the CEOs and CFOs when I got in front of them and look them in the eye and get the the nonverbal cues that were very helpful. And then I call the suppliers, the customers, the competitors. If I wanted to be fancy, I'd build a model that suggested what the company's going to be doing, that I think that the upside is versus what the street thinks. And it was time intensive, but that was all I did. Now I'm doing a lot of other things, and so I don't have $500 million, so I want to concentrate my time where I can be most impactful. And I think that's via, identifying big groups and themes via the ETFs. And I also want to point out your individual investor advantage. And I know there's this war between the Wall Street bettors and the street and CNBC. I think the individual investor has an advantage. I really do. If you know this, then just bear with me for a second. The standard way that people run money in a mutual fund setting, if you will, is there's a PM, there's a team of analysts, one's the healthcare person, one's the tech person, and so on. You present ideas to the PM. You're all supposed to do things exactly the same way. You don't. You can't. You have a mandate that you try to adhere to. You go to the left and right of it from occasion, and you have to have some financials. You're never going to be so audacious as to say financials are 10%. I'm going to be at 0 or 10. You're going to be at 7 or 13%. So it's just you have to fit in a box. You have to watch liquidity. You have to watch turnover, and it's just. My point is, you don't have any of those restrictions. All I want to do, and all I want you to do, is make money this year, every year, and compound that no matter what the market does. And given all the ETFs that are out there, there's ways to do it no matter what happens, in my opinion. So take with that what you will. DraftKings is the next one. They're losing money, so they're generating losses. And it's the same kind of thing, Charlie. I think there's a lot of good news priced in. So I'll watch these. I watch certainly the ETFs every month. But for me, I think that we've discounted all this post-COVID recovery and good news, and they got to rest for a while at a minimum. But the opportunity is monstrous. I just think it's a well-known opportunity. But this is from, I believe, Susquehanna saying that we're going to go from online gaming. Gambling is going to go from $2 billion to 20 to 40 in 10 years. I mean, it's a monstrous, and it also feeds into the same trend that I note all the time with cannabis, is that the states need revenues, and legalizing gambling is a very a relatively painless way to generate revenues. You just bring it out into the light, you tax it, and it goes into the treasury coffers. So next. What are your thoughts on Dogecoin? Is there room to make legit money there? And I had the knee-jerk response, but before I typed it, I went into Google, and I just put in Dogecoin, and this is what comes up. Will Dogecoin reach $1? So that's how you're going to make a lot of money, is going up to $1. Will Dogecoin make me rich, is the second one. Is Dogecoin a joke, is the third. And then the explanation kicks up. Dogecoin is a joke cryptocurrency that on Tuesday was briefly worth $54 billion. And what I love about these questions is that it puts up my antenna, and so I'm looking for things that I might not otherwise have looked for. And then the next day, James McKintosh in the Wall Street Journal writes, Dogecoin is a joke, but it's not a laughing matter. And then he shows this Matterhorn of a chart, which it was flatlined through most of last year, and this year it's gone from, 2 pennies to 40 cents, something like that. And I've talked about this in other circumstances before. Parabolas, when they go vertical like that, by the way, please go to the YouTube channel if you're listening to this, because I have all the visuals that I speak to here when I'm in your earbuds. But anyway, parabolas correct 80% plus. I mean, you just go through the chart book over history, and that's what happens. And so We've already come off 40 cents. We're at below 30. And my guess is that we're going to be below a dime in 6 months. So I wouldn't touch this thing with a 10-foot pole. It's a joke, literally. And there might be trading opportunities very, very short term, but I don't have any support and resistance I can use to even be helpful with that. There could be a greater fool that wants to buy it at 50, 60, 70 cents, but not for me. Not for me. So do with that. You make your own decisions, but that's my take. Next, asked about, I call them reopening plays, but it was more live event plays, partying, concerts, etc. And if you were to create a basket for tickers, the great thing is we don't need to create a basket of tickers. The ETF companies are coming up with this all the time. This is the Invesco Dynamic Leisure ETF, PEJ, and it looks like the gambling stocks. The decimation that happened last March, April, and then it started discounting through the horrible news. And now here we are at above, roughly at the same levels of pre-COVID. So I think the recovery is happening. I think we're all jonesing to go out and do things with other people, myself included. But the market is a great discounting mechanism, and I think we've already discounted much of that recovery in these stocks. So take a look at PEJ and see if there's anything in there that you want to explore or have me talk about further. But right now, they're not for me. Thoughts on eToro? I don't know eToro. It seems fascinating to me. Seems very crypto-centric. An app. But to everybody that's out there, old and new, please send me your feedback. What do you think about eToro? Do you use it? What's the good, the bad, and the ugly? And I'd like to report back and see if it's helpful to everybody else that we talk to. So, and thanks a ton as always to you, Charlie, and all the best. And I'll talk to you soon. Really appreciate it. I had a great exchange with Ace CLOP on YouTube, and he goes, "No offense, you look like a suit." And those are my words, not his. I'm paraphrasing. I wear the white and the tie because it's a little more slimming. When I did this in a polo shirt, I look like an out of shape golf pro. Anyway, I'm not the establishment. I don't buy into that whole argument. I'm not a reporter. That's another thing that you mentioned. These are my takes, and so those equal opinions. And I just want to, bring this up just to, put my 2 cents in. This whole taking down the man, the hedge funds are evil. We're going to stick it to Melvin and Citadel and Griffin and Cohen and all this. They're doing just fine. They slept really well last night. They had a wonderful breakfast, and then they went to the Mets game. So it's a romantic notion, but it's a fallacy. But I really think this is helpful. That the market doesn't care. The quote unquote establishment doesn't care what you own, what you think about what you own. It's all you, and it's either you're right with the market or you're wrong against it. And I encourage you to adopt that stance. I doubt you will, but at least entirely. But this sticking it to the big hedge funds, I think that's January's news, and it's not going to happen again. You mentioned the shorts. The shorts are way down in GME. That's a fact. Even if those numbers are a little inaccurate, they were in essence 70, and now they're down to 10 million. So, yeah, you can squeeze some, but you're not going to surprise anybody. We've had the weekend in Greenwich where every risk manager worth his salt tapped, all the analysts on the shoulder and said, hey, if there's any chance of a gamma squeeze going on, get your damn positions down. That's happened. So... and I've listened to 3 or 4 podcasts this week where there were short sellers on, and they said that's exactly what we did. We think we're right, we're going to be right, but if we're going to get squeezed in the short term, we're going to adjust our position sizes. People don't sit around like a piñata waiting for you to hit them. So I've beaten that horse dead enough. Have I done that, Mike? Okay, thanks. A fellow on Twitter, I want to say it's Dogeman. I think I've got that right. I can't recall. Sort of put it out there for everybody, and it caught my eye. What do you prefer, YOLO for cannabis, YOLO, or MJ, Mary Jane? Really clever. And I do what I always do. I go to the chart, and I do it with YOLO because I own it, and then I go to the top 10, in this case, the top 3. Once again, here's another wedge, and YOLO's up something like 70% for us, something like that, in less than a year. So if it, now the fact that it's corrected 20-30%, I don't care. We're at support here. We're at the bottom of the wedge, so I like it. Here's a little subtlety that I came up with. I didn't put this in the tweet because I found this out afterwards. And Mary Jane is the next one, cannabis ETF. Again, another wedge, looks very, very similar. And stocks move in groups. This is what happens. And if you get the groups right, getting the individual stocks isn't as important as it normally is, which is why I like it so much. What caught my eye here was that the number one name that's held by the ETF is GW Pharmaceuticals, and they're getting taken over. And it's public knowledge. It's out there. Jazz is buying them. And so, the chance of that making a big upside move from here is very, very minuscule. So that's why I think you have the upside with the active management of YOLO, and I prefer it over Mary Jane for those reasons. Bob from Boston came in. Kevin, just tuning into your YouTube podcast. Love it. God bless you. I'm doing the same thing with my boys, getting them involved. Forwarded your site to them. I really appreciate that. I like the simplicity of your approach, but with the backing of other research articles, etc., to provide the audience with their own opportunities to do some work. Good stuff. This is in the show notes, but Bob, I really appreciate it. And everybody out there, please share, especially with your kids. And that's why I do this. And we're starting to catch on, and it's very exciting for me. So here's my take. It's going to be a fun week for GME, I think. All bets are off if we break down anywhere meaningfully. XRT, the retail ETF, is my way to play GameStop. AMC looks okay, a little better than when I looked at it 2 or 3 months ago. The gambling ETFs look extended and tired to me. Live entertainment is the same. Dogecoin is a joke, and I don't want to be laughing about it, so I wouldn't touch it. And I prefer YOLO on the cannabis side. And Bob and others, please share with your kids. So thanks. Everybody, please share with your Reddit friends, your Robinhood friends, Wall Street Bet friends, and send your ideas and stocks, and I'll offer a strategy for them as well. And please stay tuned. My themes and groups, I like everything that we own. Obviously we've had some pullbacks, but you can't complain when you've had Bitcoin go up threefold, and it comes in because of the capital gains news of last week. So everything's intact. I'm watching all my levels. When I invoke my sell discipline, you'll know it. And I'm going to make sure that I don't lose a lot of money. That's one of my big rules. Podcast of the week. I didn't have anything, but then as I was driving over here, I had in my ear the All In podcast with Chamath Palihapitiya, Jason Calacanis, David Freeberg, David Katz. I think I have that right. I hope I do. And they were talking about the capital gains tax hike that's proposed by Biden, and it's just a good reality check. He proposed doubling the capital gains tax for take out the rich people, those making $1 million plus. And, all these guys said, we're not going to sit here like a piñata either. And it's justifiable. They're going to move to lowest tax states. You can set up a charitable organization where you have to pay out 5%, but then everything inside the charitable organization is tax-free. It's just, by the way, it's a trial balloon, and it's not going to be the number that he came up with. It's going to be lower than that. And so the reason I bring this up is that I think that the decline we saw in the stock market the minute that hit, and the big decline we saw in crypto the minute that hit, I think that's going to turn around next week. That's what I think. People are going to be more calm, and they're going to do the kind of thinking that I'm doing and say, let's not get too carried away. This isn't going to be that bad. Reporters of the week. This is Taylor Locke on the CNBC website interviewing Mark Cuban. And again, I talk to my sons, like to give them ideas that I think make sense. And this is pretty simple. Mark, by his own admission, was a talker. And he had a mentor that pulled him aside and said, you know what, every time you walk into a meeting, at the top of your notepad, I want you to write listen, because you're not doing it right now. And I think I'm pretty good at it, but it's a habit that I'm adopting too, because it just doesn't hurt to slow down, take in information, and absorb it before responding in kind. I produced this out of the Wall Street Journal this past week, and I just think this is a great visualization. There's the Biden plan, $2.3 billion, with someone's got to buy him a dictionary, because the word infrastructure is being torn beyond all recognition. It is $2.3 billion on all kinds of things. It isn't roads and bridges. It's roads and bridges and everything else he can think of. And then here's the Republican response, which comes in at less than 600, so about 25% of the Democrats' plan. And so this is Andrew Duehren writing, and this is my interpretation, not his, but I appreciate him putting the visual up here. They're going to meet in the middle. It's a wish list that Biden puts out, and so if you're getting all jacked up about the Biden infrastructure plays, the money's not going to be there the way the headlines state they're going to be there. There's going to be horse trading, there's going to be pork, there's going to be swamps, and a lot of waste, but the chance of that coming out at $2.3 trillion is about zero. They're going to meet somewhere in the middle, and it's the same argument I make with capital gains. It's not going to go from 20 to 39 some odd. It's going to be somewhere in the middle. And so everybody calm down a little bit. So my take is, write the word listen when you go into the meetings, and the tax plan, the negative impact on stocks and crypto, I think is going to likely reverse this week. So we'll see. Charts and tweets of the week. This is Fidelity's Jurrien Timmer, and this is kind of clever, and it came up with another CNBC interview I saw this week. But this looks a lot like coming off the 09 lows, the COVID lows and the 09 lows, and he lays them on top of each other. And it's been 14 months of pretty much straight up, and it's time for a break. That's all. And it tracks really, really closely. I recommend you going to the YouTube channel and seeing it. So back then, it was the QE1 was ending, and the market didn't like that. Now, I haven't heard anybody say the Fed's going to stop bond buying now, but if they even say anything close to that, we could pull in. And I just think you don't need to sell everything. You don't need to panic, but just know that it's logical that you can have great earnings news like we've had and stocks not do a heck of a lot. And I know it's counterintuitive, but I want to give you the context so that maybe your expectations are adapted a little bit. Next is Josh Brown. I just like him, and he put out on LinkedIn, what's the dumbest crypto thing I can buy right now? I need to ironically double my money in the next 24 hours. And I put that up, and then I wrote underneath it, please see Dogecoin. So, realize what you're dealing with. If you want to gamble, great. Know you're doing it, and do it with a small amount of money. So my take is, it's 14 months up is a pretty long time. It's time for a breather. There's some other logical reasons for the timing of this. I'll go into that. And I like Josh Brown. There we go. Newsletters of the week. Bear Traps report, and there's an old Wall Street adage. If you've heard it, then just bear with me. But sell in May and go away. And you go, and that's a bit extreme. You don't go to 100% cash and then jump back in. But here are the numbers for the Dow Jones since 1950. I can't imagine the other indices are dramatically different than this. But from November to April, you're up 1,200% over that period of time. And from May to October, you're up 27%. So that's 70 years of data since 1950, and it's obviously skewed by Lehman and the 87 crash, which I mentioned, but the performance is really much better in that November to April time period. So it's April 24th, and get ready for some softness in at least some sectors of the market. So my take is at least adjust your expectations. Pay attention to the sell and may go away. Don't do it entirely. But if you have weaker names that are violating the sell discipline, don't waste time getting that dead money out of there. And I think this dovetails with the 2010 analog pretty elegantly, and I thought I'd bring it to your attention. So that's the show. Please subscribe to my YouTube channel, and many of you are, and it's growing nicely, and I really appreciate it. The audio is the same, but the charts that I reference are on the screen. Please follow us on Twitter @BakesTakes_ and other social media. Please use your voice memo app, tape your questions, and email to bakes@bakestakespodcast.com, or write in if you'd prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Thank you very much. Have a great week. This is Bakes, and for much needed levity, this is Jim Gaffigan. Bars are adult playgrounds, and I think it's pretty funny, and I hope you do too, and I'll see you next week. Bye now.